think of a playing card. I know it's random, but think of one. You got one in your mind? So the card you're thinking of is something we don't have time for.
Today I saw Andrei Jikh posting a video on the best months to buy stocks, and that really caught my attention because I want to see whether or not he has strategies to time the market. Because if you're fundamental like me and Andrei Jikh, normally you wouldn't really time the market, you just buy and hold and never sell. But since he posted a video like that, I just want to take a look at it. I just want to know what is his opinions on this. Stay tuned to the end of this video because I will let you know whether or not my opinions are aligned with Andrei Jikh's and whether yours should be aligned with his. And if you're new to his channel, do remember to subscribe and turn on the notification bell. That way you can learn more about stocks in an entertaining way. And as usual, do remember to smash the thumbs up button.
Did you know that if you bought one share of JP Morgan back in 1898 that you'd no longer be alive?
First of all, I just like to say that Andrei Jikh has so entertaining videos. I just love his videos. Now I'm gonna label his points one by one. So let's start off with the January effect.
The January effect.
He's saying that in the beginning of the year, the stock market wants to go up. And he has two reasonings backing up that theory. What happens is the masses want to pay less tax. And how they do that is basically selling their losing stocks, giving them the write-off, which gives them the money to buy back into the market once again. And he claims that most of the time this happens in January. Aside from that, he also mentions about the psychology of the masses, and he mentions that a lot of people in January have this New Year's resolution mindset. Therefore, a lot of people have the intention to buy stocks in January based on their New Year's resolution. However, this affects mostly on low cap stocks. The reason to that is because a lot of these investors are not as experienced
and they want to see more gains in their shares.
Rather than 20 to 30%, they want to see 100 to 200% gains. This next theory is called the Santa Claus rally.
Now the second thing that they look forward to throughout the year is something called the Santa Claus rally.
What this means is the 5 last days of December and the first 2 days of January, generally stocks tend to rise. His reasoning to the Santa Claus rally is that most people get paid their bonuses, start shopping, start spending money all at the end of the year. Therefore, a lot of companies do better and their stock goes up. And according to him, another reason is that people anticipate the January effect. So they generally try to do the front-running effect, whereby they try to get into the market before the others to get a cheaper price. But in most cases, if the Santa Claus rally does not occur, then there's a very high chance that the January effect will not occur as well. Not only that, but stocks may tend to go down in January if that happens. The next theory points out is sell in May and go away.
Sell in May and go away.
So his reasoning to the psychology of this all is that a lot of investors get into the market at the start of the year, sell off in the mid of the year, which is May, before the May market crash, and get back into the market around November anticipating the Santa Claus rally. His explanation to this is very interesting, and he said it's related to some old fancy tale.
It's actually a cool story. So the origin dates back to aristocratic society of ye old London, where people would go to something called St. Leger's Stakes, which was a horse racing event where the wealthier class would go in order to escape the hot summer months. And thus the old saying was born, sell in May and go away and come back on St. Leger's Day.
But I believe in him.
Because Memorial Day starts on May 31st up to September 6th, generally people tend to take the money out from the stock market and use it for vacation expenses, and therefore causing the market to have a mini dip.
The fourth thing that investors look forward to throughout the year is October. It's called the October crash.
And this one, he has a lot of past data to back this theory up. But in my opinion, this data is not enough to conclude that this theory is actually real. Because if you notice, he said there's an October crash in 1907, 1929 and 1987. But from the year 1909 till now, it's a lot of years, and this is only 4 years out of so many years. Therefore, I'm sorry, but I don't think that this theory is valid. But like I said, this is just my personal opinion, and actually we can monitor the market from today to October this year. And let's see how well the October market this year performs. He also mentioned that the real red month is actually September, but people only start realizing in October. That's why it's called the October crash. And he saw a bunch of bear market patterns from 1987, 1990, 2001 and 2002. This data could be more credible than the previous one because this data started from 1987. That means the year from 1987 till now is is not that many years, therefore the percentage of it crashing is higher than the last. Therefore the probability of it crashing is higher than the October crash. Then he mentions the best months to invest, which got me very interested. April, October, November and December. Right after that he mentioned that Monday is the worst day for investing.
So the worst day of the week to sell stocks has actually historically been on Monday.
And his reasoning to this is very smart. I completely agree with this. And his reasoning is that companies prefer releasing bad news over the weekend because people tend to be too busy shopping, doing their own stuff, relaxing, and therefore leading them to only realize the bad news on the Monday, causing them to start selling on the Monday and causing all the stock markets to go red. However, I would say that Monday is not the worst day to invest in stocks. It's just the worst day to look at them. Because for investors like Graham Stephan, me, Andrei Jikh, we prefer to get into the stock market at a discounted price, which would probably be Monday. What I like about Andrei Jikh is that he says never sell, smash that sell button, don't use the sell button, and I completely agree with that.
The best time to sell stocks is never. Don't ever sell your stocks. Just break your sell button.
Because if you're a fundamental investor, you should really just hold on to your stocks and not sell them. Because if you're thinking of selling them in the near future, then you shouldn't probably even buy them. Because if you really believe in the company's vision and mission, and you really believe that this company has massive potentials in the future, then you should just buy and hold your stock for 10, 20 years. And the last thing he talked about is, do you buy in lump sum or dollar cost average? His personal opinion is that he prefers buying in lump sum. My personal opinion is not depending on the person, but depending on the stocks that you're buying. If I'm going for stocks that I strongly believe in the future, I would just go in one lump sum. Because to me, it doesn't matter how the price fluctuates, and also it cuts a lot of stress down. But if I was buying a speculative stocks which has huge volatility, then I prefer the dollar cost average because I want to take the safe road in. I do not want to go in one lump sum, and whether it goes down or up, that's more like a gambling bet. And that's all I have for today. Thank you guys so much for watching. It's time to drink my coffee now. See you guys next time. Peace out.